I suppose the big question on many investors' minds is now a good time to invest in gold. We believe that it is prudent to have, at the very least, a small amount of your savings or investments allocated towards gold. In order to understand why, really we need to look at both supply and demand dynamics of gold. If we look at supply of gold, all of the gold that's ever been mined or picked up off the ground has been estimated to be approximately 170,000 tons of gold. This is equivalent to the size of a cube that would fit onto centre court in Wimbledon, with sides only 21 metres long. Also the equivalent of an hour's worth of global steel production. So we can see that gold is very scarce, and the cost of extracting gold is going up. If we look at the supply graph for gold, we can see the first trend is that central banks are now buying gold. Where for years they were selling gold, they're now net buyers. This represents an erosion of confidence in both the dollar and the euro. So now on the supply side, we're left with two main sources, recycling and mining. On the recycling side, we can see from the graph that in 2002, recycling represented 23% of supply. In 2009, that peaked at 45% of supply. And in 2011, it pulled back to 40%. So we may be seeing some sort of peak in the supply from the recycling industry, from the cash for gold industry. The current cash for gold industry is an unsustainable supply, as once the public have sold its gold, that's it. They can't go back for more. And then on the mining side of the supply graph, we can see that it's struggling to keep up with demand. There have only been modest increases in output, despite the increase in price. Ore grades have been dropping. In the 1950s, we saw ore grades of 8%, and today we see ore grades of only 0.8%, only 10% of what they used to be. There's also a lack of major new discoveries, despite a near tenfold increase in exploration budgets. Also a factor for the mining industry is its energy costs. Energy costs now represent 25% of overall costs. When we look at the demand side of the equation, we can see that we've got demand from the jewellery industry, from physical investment, which is bars and coins, fund investment. There's also industrial use and also demand from central banks. Industrial use represents about 10% of demand, and over the last 10 years it's been increasing slightly. As we discussed earlier, central banks are now net buyers of gold, and they're now on the demand side of the equation. There are three other trends in the chart that we can see. First of all, we see that jewellery demand is subsiding since 2005. Physical demand in the last 3 years has increased, and fund investment in the last 3 years has subsided slightly. This pullback in fund investment in the past 3 years may indicate that investors are no longer willing to expose themselves to third-party risks. Fund investments such as ETFs use swaps, leases, futures and options and other over-the-counter derivatives which incur third-party risk. The trend is heading towards physical, outright ownership of gold, like with that of gold hold. When we look at where a lot of this demand is coming from, we can see that a lot of it comes from emerging markets. In fact, China and India alone represent 50% of demand for gold. And if we look at the figures, we can see that this makes sense. They have a growing middle class. In fact, across Asia alone, the middle class outnumbers the entire US population. They also have rising incomes. They also have strengthening currencies. They also have high savings rates. There's also a legacy across Asia of distrust for paper currencies due to the Asian currency crisis of the late 90s. They also have a growing distrust of Western currencies and particular Western debt. Another factor that must be taken into this is China's aspirations for global economic dominance. And as a part of this, their currency is crucial. Many analysts believe that China aspires to back its currency by gold, and there are indications that this is already beginning to happen. They're buying all the output from their own mines. They've also bought shares in all of the world's top gold mining companies. They're also encouraging their citizens to buy gold through state-sponsored advertising on television, and also by opening state-sponsored retail units selling bullion across China. The last factor we need to look at in the demand equation for gold is inflation. And the question is, are we going to see inflation in the future? Inflation is driven by demand, cost, and money supply. If we look at the demand side for global services, we see that emerging market middle classes all aspire to have a consumptive lifestyle. Developing countries represent half of global oil demand. In the last 5 years, they've represented all of the net increases in global oil demand. China now consumes 40% of metal supplies. Costs also look like they're set to continue to rise. If we look at oil and food prices, labour costs across Asia, China's minimum wage in 2012 is set to increase by 13%. And similarly in India, their minimum wage is set to increase by 11.9%. The last factor to look at is the money supply. All major Western banks are engaged in quantitative easing programs. European Central Bank, the Federal Reserve, the Bank of Japan, the Swiss National Bank, the Bank of England. As Western currencies continue to increase their supply, Western currencies will continue to devalue as they're debased. Purchasing power will be diminished and savings will be hit.